Trade finance is possibly one of the oldest services that banks provide for their customers. The value of global trades today is nearly $32 trillion. But banks participating in traditional trade finance are facing challenges like low growth, fee and expense pressure, mounting regulation, changing customer expectations, to say nothing about global uncertainty emanating from world events. So today, I've come to NatWest, one of the world's leading financial institutions. I'm here to meet with Jatin Lealh to get a perspective about the future of trade finance as multiple forces combine to drive a profound transformation in global trade and supply chains. Jatin, perhaps I could start by asking you, what are the main challenges facing banks participating in traditional trade finance?
SME inclusion at scale is the biggest challenge. There are 5.5 million businesses in UK and 99% of them are SMEs. And when you look at the export data, what it tells you is the 99% of the SME is only responsible for 25% of the export of goods. Well, that highlights a very clear participation gap, because the remaining 1% is doing 75% of the exports really. And the reasons are actually quite practical ones, which are the KYC, AML and compliance that traditional trade requires to instruments like LCs and bonds.
What part is innovation now playing in trade finance? Are financial institutions participating in traditional trade finance investing in innovation quickly enough?
Banks are 100% investing in the innovation quickly. The challenge is adoption as well. And adoption will come from education. You know, there needs to be a lot of education distributed to the business community by government, by banks, and that will all play a catalyzing role. And I think AI will actually transform trade finance in future as well. Machine learning as well as optical character recognition, both combined, can very easily tackle the challenge of reviewing documents at pace.
With me now to talk about exciting new developments in trade finance is André Casterman. André, thank you for joining me today.
It's a pleasure, Chris. Glad to be here with you.
André, what would you say are the main challenges now facing banks participating in traditional trade finance?
There are a number of challenges for trade finance banks. It's I would think at three different levels. First, at the processing level, the cost of onboarding clients, in particular low volume clients. The cost has been rising due to regulatory requirements, and also the cost of processing paper-based transactions that the clients are delivering, in particular in document trade finance, which is why the open account space has been growing so much in comparison. There is another level, which is the accounting level, where balance sheet management and risk-weighted assets have been increasing following the Basel regulations. So this is putting pressure in particular for banks as they originate and hold the assets on their own balance sheet, which is driving distribution. And then at transaction level, and market level, there are fraud and credit risks. But this is often mitigated through proper credit underwriting processes, governance within banks. However, the fraud risks are the most challenging to spot.
Yeah, what can you tell us about exciting new concepts like securitization and tokenization of assets? And how does tokenization work, and how will that benefit banks participating in trade finance?
Yes, definitely. So first on the established practice of securitization. This is a very common practice in capital markets across multiple investment classes. And the trade space has been indeed partnering with institutional investors since a decade or so. It's still nascent, I would say, but there are major programs, securitization program by top banks that have been going on for more than a decade. And now we see more and more smaller banks, non-bank lenders also taking advantage of securitization in order to benefit from the involvement of institutional investors, really on the capital market side. Now, tokenization is very similar in a way. It's very similar because it's all about being able to raise liquidity from asset managers, but the tokenization suggests that the rails are far more digital than they are in securitization. So we can really look at tokenization as a digital twin of securitization. Now, in trade finance, the tokenization is actually also relevant across other use cases. For instance, through the Global Legal Entity Identifier Foundation, the LEI, tokenization can be applied to digitize identities, signatures, credentials. That's the first use case. It can be used, and it is used today in production by some banks, to digitize negotiable instruments like promissory notes, bills of exchange, but also bills of lading in the transport space. And this relates to the ETD Act, which was made available to the market in September 2023. And then also we heard more and more about stablecoins. Tokenization can be used for settling transactions using regulated stablecoins. And then the fourth use case is the one I started with, which is all about launching investment products to transform trade assets into investment opportunities. This is very early stage at that level because securitization is the way to do it at this stage.
What can you tell us about new trade working capital finance offerings gaining traction due to, let's say, their reduced operational complexity, streamlined compliance, and new tech-enabled business models?
So APIs multiplied by data will turn working capital into an always-on utility. Working capital is no longer about just supply chain financing or receivable financing. Banks, including us, we are investing in pre-shipment facilities, trade finance loans, bonding and LC lines, and making the whole experience digital for our clients. And then there's this whole public-private partnership. So I'm referring to UK Export Finance. So they act as a catalyst for us to provide these working capital that businesses require before they actually ship anything out. And the government can give us up to 80% guarantees, which reduces the requirement for collateral security. And I do think compliance will get better with AI because it's just a very manual paper reviewing process. Compliance is really.
What do you see as the future for traditional trade finance components like letters of credit, receivables, and standbys?
Instruments stay, but paper will disappear. If someone's asking a question, are you going to have letters of credit or standby LCs in future? The answer to that is yes. I can't see a future where someone will say, well, we don't require payment certainty. And that's exactly what these instruments do. Payment certainty will always be required in future.
Could we talk about the growing role of institutional investors, capital markets, who are becoming partners of banks and non-bank lenders in trade finance and lending?
Yes, this has been a major theme I've been involved in over the last 15 years. Basically, it's mainly for banks to increase their funding capacity, to work with partners such as pension funds, other types of asset managers, and also sometimes family offices, and enabling banks to grow their capacity to increase the velocity of their balance sheet. So that has been the traditional way for institutional investors to engage. Now, more recently, through bank de-risking and following the consequence of Basel regulations, the new entrants have entered the market, non-bank lenders, we call them. They're focusing on the SME space, financing receivables, payables of SMEs. And those new entrants, they have no balance sheet to rely on, because they are indeed startup level businesses. They are not large banks, so they apply what we call an originate and distribute market practice, which is suggesting that they will originate and immediately engage institutional investors in transactions, because they don't have the capacity to originate and hold. So institutional investors have become very important for those new entrants, and also find a way to deliver yield on transactions, because those non-bank lenders often support SMEs, which are more risky but deliver more yield at transaction level. So there is a nice collaboration here between those new entrants and institutional investors.
So, the future of trade finance. At NatWest, we saw how onboarding SMEs is a big challenge. We learned how AI is going to transform document processing, so important in the mitigation of ever-present fraud risk, and how traditional payment guarantees like letters of credit and standbys will remain whilst paper disappears. And from André Casterman, an important ITFA board member, we saw how securitization and tokenization are going to make it easier for participation by low volume participants, but more importantly, enhance liquidity by participation of non-bank financial institutions like pension funds and asset managers. The future of trade finance, a work in progress.